Well, I'm thinking as well of Compass Group, which was just also on our air this week talking about their third round of layoffs. Why is Zillow going to benefit from the same climate that they are suffering from dramatically?
Really good question. So 3 things drove the upgrade. Number one, surely fundamentals are challenged right now, but we do think that trends could stabilize or trough in 1Q. If you look at some of the leading indicators, like mortgage purchase applications, which are a good indicator for home sales, those have really stabilized over this past 3 months. So that does give us some confidence that trends will start to improve. Number 2, if you look at our view for growth in 2024, we think the market can go about 10% up on improving affordability, mostly on rates going lower, as you mentioned, and pricing getting a little bit better. And then number 3, specifically for Zillow, they've got a number of growth initiatives in the works right now. They're still early stage, but we think it could get growth above the market. We think EBITDA could double from this year to 2025. And shares are still below historic multiple averages. So, we thought risk reward looked pretty favorable.
Remind me how Zillow makes money currently. When we all look at properties, and of course we all do, we're on the website stalking things all the time, but the real money is to be made in those when you click to connect with a realtor. Is that the idea?
Yeah, that's correct. So if you or I were to go onto their site and click a button that they have on the site that says, I'm interested in this house, that sends the signal out to the buy-side agents that are subscribers to Zillow. Those leads, then can lead to, hopefully a positive transaction. And yeah, that service is what agents pay for and how Zillow makes most of its money.
So I was speaking with an agent over the weekend who says this is the least amount of inventory she's seen on that market in her town in 40 plus years in business. That has to be a major headwind for a site like Zillow.
Yeah, it has been. It is. So if you kind of look at, where trends have gone, market's been down on a volume basis basically since fall of 2021. So, yeah, look, things are still difficult, right? We're kind of in the middle of a buyer and seller strike, but we do think that in terms of at least the trends, they start to get better, at least in the next couple of months. Again, as pricing eases and mortgage rates get a little bit better, that should bring some people, back into the market. But yeah, still tough conditions out there for sure.
What's the valuation and what kind of multiple do you think is justified? And do you think that we can reasonably forecast their earnings over the next couple of quarters in this kind of market?
Great question. So in terms of, our valuation basis, we're based it on 16 times forward EBITDA. That compares to historic average about 21 times. In terms of forecasting, yeah, really good question. If you do look at, how their trends or their revenues have trended relative to the market, they're pretty much in line or have been for the past 4 or 5 years. So, yeah, look, it is a market call in terms of, how we're more positive on Zillow right now. But, we do think that the market can return to growth. And if that's the case, Zillow should be right there with it.
Finally, this isn't the only company you cover. You've got to buy on RH and underperform on Wayfair. Are those company specific, or does that also jive with what you've been telling us about the housing market more broadly?
Yeah, for sure. So, starting with Wayfair, yeah, we are underperform rated, a better housing market. That's not a bad thing for them. But unlike Zillow, they're not a direct beneficiary. And as we outlined in a note we put out for our sector yesterday, we do prefer earnings quality. Looking at Wayfair, earnings have been pretty volatile. The margins are negative. Cash flow is not particularly high. So earnings quality isn't all that high. At least in our view for Wayfair. And looking at least how their business is done, better holiday, but we don't think that's sustainable. Largely due to the fact that we think it was at least in part driven by more vendors going to them to clear excess inventory, and that could fade in time. Quickly here on RH, yeah, look, housing market's been on tough for them too. Rates the same thing, but looking at the track record of this history, they're a proven share taker over many years.
Yeah,
they've got a bunch of initiatives, right, like a new international business that's coming, and the largest product launch in their history. So. We do think that they can return to growth in 2024. And last week they announced or put out a press release that basically said, that they had accelerated their share buyback. So, that could mean that business, the management team could be a little more confident in the business. So,
no, the share moves have
buy rating that.
Absolutely. On Zillow in particular, 14% in 2 days has people asking questions, and you've got a little bit of the reason why. Thanks for joining us, Kurt. We appreciate it.
Thanks, Shelly.
Curtis Nagle.